Hey there, welcome to Wealth Addicts. This is the show where we're going to teach you how to protect, grow, and leverage your wealth using different alternative strategies that we have found and use in both advisement of clients as well as personal balance sheets here. So with me today, joining me, I've got Jason Franciosa going through here, and we're going to talk about a topic that we've both discussed at length and looking forward to getting into here today. Jason, how are you doing?
Doing great, Sam. Thank you very much. Yeah, I just wanted to go over really quickly. If someone's getting a whole life insurance policy or a universal index life insurance policy, what are the key things that they should look for to make sure that it's being structured properly and it makes sense for them as an investment?
Wonderful. Absolutely, dude. No, I appreciate this video more than you can know because I like being able to get to the facts of the matter. It has nothing to do with who's selling a policy. It has nothing to do with what carrier is marketing a policy. This is all about what is the best for each person and knowing how to give you the tools so you can make confident and good decisions. So without any further ado, what I'm going to do today is I'm going to show you how to evaluate any policy. It doesn't matter which carrier, which policy type, which strategy it is. You can use these tools to evaluate whether or not it makes financial sense for you. And then in later videos, we can get into more detail if you want to, but to keep it high level. So today, I'm going to show you what to obtain and where to review on it to understand how to compare these policies. So here's what you should do is number one is you need to ask your agent to include with any illustrations you receive from him an IRR report. IRR stands for internal rate of return. That's going to show you the amount you put in the policy over a period of time. It's going to show you at a point in time in the future the total amount you have left of net cash value. And it's going to say along the way, here's the compound annual growth rate for what we earned along the way going forward from the day we invested capital or the deployed capital to the day that we were able to surrender or pull capital out in the future. So it gives us a really good picture there. So we want that IRR report. Agents are often reluctant to give it, but that's maybe assigned to you. So you should make sure you get that in place. The IRR report, as we review it, I'm going to pull up one here real quickly. The first thing I look for, and this is actually on a whole life illustration, the first thing I look for is to know what is our liquidity in year one. I want to have a year one liquidity of over 70%. The reason that's important is because our liquidity year one determines what our opportunity cost is. If we put in 100,000 and can only get to 2, we have a large opportunity cost that makes it so we can't invest in other things. If we put in 100 and can get to 70, we can still pull that capital back out if we needed to infuse it into our business or to other investments. So piece number one is look at year one and say, how liquid am I in year one if I wanted to surrender or loan against this policy? So you can see it right here. With this one, we're over 70%. 70% is what I believe to be my threshold. That I would say if you're under 70%, review the policy with a secondary advisor to make sure you're not getting something that is structured less than optimally for you. Number two, look at when you break even. Number two is saying, as you see here, we're going to break even year 5. What break even means is we put in X number of dollars and we have more cash in the cash value than we put into it. That means that our risk at that point, if we decide to walk away, is essentially zero, because we can walk away with more cash than we put into it. So that's a great risk mitigator on your side, is if you have more cash you put into it, you're in a position of power. So step number 2 is see, when do we break even? I don't want to see a break even any later than year 5. Year 5 is as late as I would like to see it on a policy. There's different factors that may adjust that from a health standpoint, but as a general rule of thumb, we want to see you break even by year 5. So piece number 3, and the last and final one is probably the most complicated, is this is our comparing our long-term IRR to determine an expense ratio. What you need to know to do this is on your IRR page or perhaps somewhere else in the illustration, it is going to tell you what is the gross return applied to the fact pattern of this illustration. So it's going to give you 20, 25 years, which you'll see here. See how it's got 25 years. It is applying a gross rate of return each year, year over year going forward. So we need to know what was that gross return. So let's just say in this case, it's going to be 6% on the illustration. If our net return, which is here, is 4 something percent, then that's going to tell you what the expense ratio is. Because what we can do is we can subtract from the gross return, we can subtract the net return. The difference is how much was lost to expenses. So gross, net, the difference is what was lost to expenses. Divide that by the gross, and that's going to tell you what your expense ratio is. I want an expense ratio on any policy you're reviewing to be less than 20%. So if you look here, you can see how this fits that bill. And we're going to go over here. I'm going to also review an index life policy at the same time. And you can see these numbers are very, very similar. The IRR report is laid out in a similar fashion. And you can see year 1, our liquidity is here. It's a higher liquidity, which is one of the strengths to the index policy. Our break even is here in between year 2 and year 3, which is of course attractive from a risk standpoint. And then our year 25 rather, IRR is here, which is well beneath the 20% threshold we put on. So remember those 3 thresholds though, if you can track those, anything you review should look like what I'm showing you here on the screen today. If it doesn't, you need to understand why, because that means that there may be something that you're missing and could be done better for you.
Awesome. So just to recap that real quick, when I look at the IRR report, which I can get from my agent, I'm going to look for 3 things. Number 1, is my liquidity over 70% in the first year? Number 2, is my break-even point 5 years or less? And with index life, you typically see that earlier than whole life. And then number 3, is my cost of the policy by comparing the net versus the gross return less than 20% difference?
Absolutely. You've got it. That's
Awesome.
That's perfect.
Awesome. Thank you very much, Sam. Appreciate it.
If you have any questions about this, please feel free to leave comments in the section below and subscribe to the channel. We have a lot more videos coming out soon dealing with multiple different types of investment strategies, including more videos specifically on universal index life and whole life insurance to be used as a banking source. Thank you very much.